Hi students and welcome back. We were discussing about the different type of the capital budgeting techniques. We have discussed about the first basic technique, which is non-discounted technique, or also called as the payback period, or even the accounting rate of return we have calculated. Then we have calculated the net present value and the profitability index. The next technique that we have is very important. That is the internal rate of return, or what we call as a IRR. Internal rate of return, or IRR, is a technique that is mostly used where we can get exactly that how much this project is actually achieving. See, one thing is our target. That is, for example, the company has a target of 10%, 12%, 13%. So in the NPV, what we get that either this project is achieving that percent. Okay, if it is achieving that percentage, we are accepting it. Means it is a positive net present value. But if we want to get that, for example, if you have accepted the project with a 10% discount rate and it is positive NPV, so it means it is accepted. But we want to know that how much actually this project is giving us as a return. So that return is basically called as the internal rate of return. So in this question we will discuss that how the NPV is calculated and how we relate that NPV to the IRR, internal rate of return, or the IRR. See, we have a very simple example that we have already used in the previous examples. The company has a one project with the outflow of the 60,000. So this is the one time outflow of the 60,000, and then for the next 4 years it has an inflow of 20,000. Same inflow. For the simplicity purposes, we have calculated the same inflow for that. Now what we have to do, let's say the company has a 12% rate of return, that is the required rate of return, or what we call as a cost of capital, or the discount rate. What we do, we will simply calculate the discount rate at the 12%. So at the 12%, we are getting 17,000, 15, 14, and 12. This method we have already discussed in the discounting calculation while doing the compound calculations, or the compound interest calculation. So this is the net present value. So the present value of the total is how much? 60,747. So what we are getting, so 60,747 we are receiving, and what we are paying, 60,000. It means there is a positive net flow, or the net present value is a positive, that is how much? 747. So it means this project is giving us more than 12%, because at 12% what we are getting, a positive value of $747. Now we have to do what we need that where the net present value is exactly equal to 0, means that what we are actually getting may be more than 12%. And obviously in this case it is more than 12%. How we know? Because if the answer is positive, means that we are getting more than 12%. So for this purpose we have to use a hit and trial method. What we have to do, we will calculate one more discount percentage. Let's say we are using here a 17%. It is not, you can say, really true that you have to always use 17% or something. So anything above 12%, maybe 14, 15, 17, any amount you can calculate. So if we are using the 17% discount rate and we are getting the net present value, and net present value here is how much? 5,136. But that value is what? That value is negative. So now we have one positive value and one negative value. Even some other person or some other student may be doing what? Maybe calculating this at the 15%. So that will also be equal. Okay, so there is no issue in that. Simply what we have to do, we have to get 1% where the net present value is positive, and 1% we have to use where the net present value is negative. So it means now we have 12% and 17%. So now we have a range. Basically, by using the hit and trial method, what we are getting a specific range. Means this project is giving more than 12% but less than 17%. So now what we have to do, we have to calculate exactly that how much this is giving. So we have a rough idea now. It is more than 12%, and less than 17%. But how much exactly the rate of return or internal rate of return we are getting? For this purpose, what we need a simple interpolation method. Interpolation method has a very simple formula. What we have to use, if you see here, we have a positive net present value percentage. So where at 12% we have a present value as a positive value, so it means we have to use here as a 12%. Then what is the next thing? Difference of the positive and the negative percentage. So positive and the negative, so the difference is 12 and 17, means almost 5% difference is there. Then we have to use the net present value, which is the positive, it is 747, divide by what? Divide by the net present value, which is positive, minus the net present value, which is negative. So minus minus, obviously it will be plus. So in this way, how we will calculate? So here we have done already the calculation, very simple one, that we are getting like a 12% here as the net present value, where we have a net present value is positive, and then 17 and 12. So the difference is how much? It is 5%. So but we have to take the ratio, that how much of that. So net present value positive 747 we are using here, and then net present value which is positive, and then minus minus plus the net present value which is the negative 5136. So what we will do, we will get the total of these, because negative negative is the positive. So 17% minus 12%, so the answer is what? Is the 5%. So then we have to take the ratio of that, 747 and 5883, so it is almost like a 0.12. This ratio we have to multiply with the 5%, so the answer is 0.63. So it means 12 plus 0.63, so the internal rate of return is how much? It is almost like a 12.63%. One other person may be using like a 10% here and 15% here, so the answer will be almost like a, within small decimal differences may be there, but answer will be like a 12.63 or 6% exactly. Means any person who is using hit and trial, maybe one person is using here, like as we said, like a 10%, and here they're using 15%, or one person may be using like here like 11% and it is 16%, but the answer will be same, because we are getting the ratio of the differences. So this is basically the internal rate of return. Now it means this project is giving us 12.63% as a return. Our required rate of return was how much? That was the required rate of return. What we said, required rate of return was 12%, but this project is giving 12.63%. Now, in the same way, what we have to do, there are multiple projects are there. For the same investment, there may be 2-3 different projects, or the different options are there. One other option, let's say, is giving you like a 12.93%. Other option is giving you 14.12%. So what we have to do, we have to select the option which has the maximum internal rate of return. Like for example, it is A, it is B, and it is C. So what we have to do, we have to go forward for the 14.12%, because this project or this machine or this investment or the capital budgeting project is giving us the maximum return. So the return here we are getting 12.63%, but another project is giving 12.93, one other project is giving 14.12. So where we have to select, where we have to go, which is giving us the maximum internal rate of return. So it is here like a 14.1% in some other project, like a project C, so it should be accepted. So this is how we are calculating the internal rate of return. If you have still any doubt, any question, you can ask me in the comment section. Thank you very much.